Good evening, everyone. Let us start. Then the others will join us. Let me just share the screen then. Okay, guys. The last time we started to talk about the EPS, the earnings per share. EPS, we said it has got divided into two parts, which is simple capital structure and the complex capital structure. With the simple capital structure, we already discussed it. We said the way how to find it, where we said there's a specific formula that has been used. It's net income minus preferred dividends over the weighted average number of the common shares. This is the last time we've been discussing. We made several examples, and I have given you some class participation activity as well. You did it and submitted. This is what we did it. And today we're gonna talk about the EPS based on more complicated one, which is a complex capital structure that contains dilutive securities. And the example of the dilutive securities, we said that it is the options, warrants, and some convertible securities. So we're gonna solve some, I'm gonna give you the definition, I'm gonna identify what does that exactly means, and we're gonna have some examples on that to understand better. So, coming to diluted EPS, so before calculating it, it is necessary to understand it. Like, there are two types of securities, which is under the complex capital structure. The first one is the dilutive securities. The other one is anti-dilutive securities. So the dilutive securities are the stocks, options, as we said, is a convertible debts or convertible preferred stocks that basically reduces the APS if one of the options are exercised or if the convertible debt is exercised. So it will reduce the APS because the number of the shares is increases. That's why it makes downwarding the EPS. However, if while calculating the dilutive EPS and you realize that your EPS, instead of decreasing, it goes up, then you will end up with anti-dilutive securities. It is the same thing like stock options and warrants, convertible debt, and convertible preferred stock. So sometimes you may be realizing that instead of going down, that you will see that the earnings per share would increase if they exercise the options, warrants, or the convertible securities. So this is mainly two parts of the diluted EPS. So coming to the more calculation, as we know that the numerator of the basic of EPS equation has got the income available to the common shareholders minus we should subtract the preferred dividends. This is what we know, and we divide it by weighted average of common shares. So in the case of diluted EPS, if there are dilutive securities taking place, the numerator should be adjusted in the following way. First, the first way, if convertible preferred stock, let's say, is dilutive, meaning that EPS will fall if it is converted to common stock, like the number of the shares will increase and there will be more added to the weighted average of common shares, and it will reduce the equation itself. So convertible preferred dividends must be added to earnings available to common shareholders. So apart from the increasing the number of the shares, it will increase the numerator as well. And if convertible bonds, in the second case, are dilutive, then the bonds after the tax interest expense are not considered as interest expense. So they need to be added back, of course, after the deduction of the tax. So we'll see in the example and you will understand better what I mean in here. So when it comes to denominator, it is weighted average of number of the shares we set when we calculate the basic one. But with a dilutive securities, the outstanding denominator, the EPS denominator is adjusted with the equivalent of the number of the common shares that would be created when the some conversion takes the place of dilutive securities, like convertible bonds, convertible preferred shares, the warrants, and the options when they are exercised. So with each considered separately, it will affect the dilutive denominator ratio. If a dilutive security was issued during the year and increasing the weighted average of the number of shares for diluted EPS, but based on the only proportion of the year, the dilutive security was outstanding. However, you should keep in mind, guys, that dilutive stock options and the warrants increase the number of the common shares outstanding in the denominator, and they do not affect, they do not make any adjustment to the numerator. Okay, so when we get into the examples, we'll get better idea how it works and where it affects it. So example 1, EPS with a convertible debt. So in here, during 2006, Triple Z Corporation reported net income 115,600 bucks and had 200,000 of shares of common stock for the entire year. The Triple Z also had 1,000 shares of 10%, 100 per preferred stock outstanding during 2006. So which means in here they had 100,000 shares of preferred stock with a 10% of dividend preferred, $100 each share outstanding. During 2005, Triple Z issued 600 $1,000 par at par, 7% of bonds for $600,000 in total. So 600 issue of bonds was issued at $1,000. In total, they made 6,000. So the coupon payment on it is 7%. Each of these bonds is convertible to 100 shares of common stock. So each of these bonds of 600 is convertible to 100 shares. And apart from that, there is information related to the tax. So there's a tax rate, which is 40%. So they ask us to compute the basic and diluted EPS. So what we will do, we will just start computing it. Step number 1. So basic EPS is equal to, if you go back to the basic EPS, it is 115,600 is the net income minus preferred dividends. If you calculate, it should be 10,000. How did I calculate? There's 1,000 shares at $100. So in total, which makes 100,000, and 10% of it will be paid as a dividend, which is 10,000. And this all divided by total number of shares which is outstanding during the year, which is 200,000. And this is equal to, in terms of dollars, 0.53.
I'm sorry, where did we get 10,000 and 20,000?
So it's not 20, so it's 200,000 shares. 200,000 is for responding.
What
shares.
about 10,000?
10,000 comes from, let me just calculate. it is, we said there are 1,000 shares times $100 par value
Okay.
makes 100,000. So 10% of this $100,000 will be equal to $10,000. Okay. And this 10,000 comes from here. Now, this is step one. We calculated EPS, basic one. There's a second step we should go with to calculate diluted one. So in diluted one, what we do here, we need to, first of all, compute the increase in common stock outstanding ones. So we compute increase in common stock outstanding, make it bigger. We compute if the bond, there is a debt convertible, if it is converted, if convertible debt is converted to common stock. So then this is should be the case. So at the beginning of the year, of course, at the beginning of the year, 2006. So which means the shares that issuable, we said there are 600 of bonds that are available. And for each bond, there will be 100 shares, 100 of common stock. So 600 bonds times 100 shares. In total, there will be 60,000 common shares if it's converted. Okay, let it be like this. So this is the step two that we try to compute. Then second thing that we need to say, that we need to find out what will be the amount that will affect our income. We know that there is a bond. If it was not issued, then we have to pay the interest. However, it is issued and we have to return back that interest paid, but after the tax payment. So we need to subtract it. We need to add it back. So what we're doing here, first of all, we need to calculate increase in income. We need to calculate or compute increase in income, because bonds was converted and we don't pay any interest. So it should be added to our net income. So the formula would go in the following way. Diluted EPS will be equal to, it is net income minus preferred dividends. We are subtracting. We said if it's subtracted, they should be subtracted. And plus the interest that we will calculate. Converted interest, we can call it. Converted interest. should be added. And this all should be divided by weighted average of common shares that we calculated before, which is 200. So weighted average of common stock plus the converted shares plus converted bond shares, we can call it converted bond shares. This will give us total number of the shares that are also outstanding during the year. So in this way, we will be able to calculate the diluted EPS. However, let us calculate. So we know the converted bond shares, we know the weighted average common shares, we know the net income, we know the preferred dividends, and we don't know converted interest. How can we calculate? It is just percentage or coupon rate of the bond value. The bond value is given $600,000 times 7%. So we get it, how much? If they calculate, let me just calculate. It's 4,200 something, but anyway, let me calculate. 42,000. Okay, this much we get it. Oops. 42,000. Okay, then we calculate after the tax. We are not going to add it. We need to pay the taxes. So 42,000 times 1 minus
taxes
0.4. Great. So this will give us 20. Let me just calculate. If you just times 42, 25,200. If I'm not mistaken. Yes, good. Okay, this is increase in income that should be added back. So diluted EPS is equal to our net income is 15,600 minus, minus dividend we paid. We said it is equal to 10,000 plus 25,200 and minus, and this all should be divided by the summation of weighted average common shares and the bond converted shares. In total, there will be 260,000. So before calculating, before getting the results, one more thing to keep in mind. As I said at the beginning, if diluted EPS computed one is more than this, okay, then it will not be counted as diluted security. It will be as anti-diluted because it is increasing the EPS. For the security to be a diluted EPS, it should be less than basic EPS. So we'll see the result. If you just subtract from 10,000 this one, we'll compute it just immediately. So 150, 600 minus 10,000 plus 25,000 200, and this all divided 106, and you should get it 0.50. 0.50. Now we can say whether our variable is diluted. So 0.50 is less.
Why should be less?
Than 0.53 because the number of the shares is increased. but the price is still the same. As the number of the share increases, and why it's increasing the number of shares? Because the converted bond shares, because the guy who were holding the bond, he decided to convert due to some reasons.
Okay.
If you remember, I put here if convertible debt is converted. There's an if condition. If it is converted, then diluted EPS will be equal to 0.50. So our 0.50 is less than 0.53, which means it is diluted EPS. If it was more than 0.50, then it wouldn't be dilutive. It would be anti-dilutive security.
Okay.
Okay. Clear all drawings. Okay. This is the calculation. Okay, guys. That we did it. It's just abbreviated shortly. Okay, let's move to another example. Look, here's the example. One is EPS with convertible debt. Now we are moving the EPS with convertible preferred stock. Okay?
What's the difference between them?
One is the debt, the other one is preferred stock.
Okay.
Like when it means convertible, it means that you can convert it. You can transfer your preferred stock to common stock, or you can transfer your bond to common shares. Now, what we're doing here, so let's read. During 2006, Triple Z report net income and 200,000 shares of common stock and 1,000 shares of the preferred stock outstanding for the entire year. Triple Z 10%, $100 per value preferred shares are each convertible into 40 shares of common stock. So each of the preferred stock is convertible to 40 shares. And the tax rate is 40%. Compute the basic and diluted one. So we start with the step one again. Step one, basic EPS. I don't need to calculate again because it's already calculated. It will be the same. $0.53. $0.53. Then, in second step, step number 2, we will calculate the diluted EPS. So, but we need to start with numerator. So we are trying to find, is there any increase in income? If you remember, as I told you, only in 2 cases, there will not be increase in the income on the numerator, okay? Okay, just let me just copy this and I'll come to something. Look at here. This is numerator, this is denominator, guys. And it is said that only in 2 cases, when it's a stock options and the warrants option and warrant stocks, they will not be affecting the numerator, they will affect only denominator. But preferred stock convertible and bond and debt convertible securities, they will affect both numerator and denominator. This is, you should keep in mind. So when we compute in here, we should always try to see there is should be increase in common. First we start with the denominator. Let's say we want to see increase. We will compute increase in common stock. Common stock outstanding. At the beginning of 2006. So how can we calculate? Who can help me? How many common, the common increase in common stock out at the beginning of 2006? We need to convert the preferred stock. We said there are 1,000 shares of preferred stocks are available. Preferred shares times 40. So for each preferred share, we'll have 40 common shares, 40 common stock. In total, we're going to have common shares equal to 40,000 common shares. Okay, that's great. Then there is another question that needs to be raised. If preferred shares is convertible, if preferred shares is converted to common shares, then is there that the company should consider the payment of the preferred dividends? Does the company have to pay the preferred dividends if the preferred shares is converted? Logically, no, because you already convert the common shares and all the dividends should be paid as a common shares rather than the preferred. That's why it should be added back to net income in the formula. If you remember in EPS, so the diluted EPS is equal to net income minus preferred dividends plus preferred dividends. So we should add it back. And this all should be divided by weighted average of shares plus converted preferred shares. So let me just put the parentheses in here. So diluted EPS is equal to 150,600 minus 10,000 plus 10,000, and this all divided by 240,000. In total, it will be equal to, if you calculate it, 4.48. Is our securities dilutive or not? We can answer.
Yes, it's dilutive.
So why? Because it is lower than basic EPS.
Yes.
Okay, save it. Any question, guys? If you don't have any questions, let us just continue.
Oh, no, teacher, can you
Yes.
proceed to the previous one, because I want to photo
Compare. Okay, you want to compare them. Here, oops.
where you wrote the same, but also you wrote basic EPS fully.
So this EPS with convertible debt.
Yeah, I know, but where's solution where we wrote?
Where is the solution when we do it? Okay, just a second.
Are you gonna give us an assignment?
Yes, I'm gonna give. I just saved it as a screen, then I have to just wait. How can I?
Are we saving the video as well?
Yeah, I'm saving the video as well.
Okay.
I'm saving the video. Saving, don't worry. Didn't forget it. Okay. Here, the solution is here.
Yeah, thank you.
I'm gonna
Okay.
send you the screenshot as well, but it will be in the video as well, which I will put it in Moodle. You can just check it.
Okay.
Okay, thank you.
So I can close it.
The assignment will be at home. Is this correct?
Yeah, yeah.
Okay.
Anyway, it will be at home. You cannot come to the class.
After the class, we have to do it.
Don't worry. You have
Okay.
today midterm? Okay.
We did it
Tomorrow.
Okay, this
No, we
example.
don't have today.
tomorrow. We have. Well, yeah.
So this is the answer for the second one here. Basic and computed. Okay, now we're coming to the stock options. Okay. In stock options, what is given here? Let's read it. So first two examples was convertible bonds, and the other one is convertible preferred stock. Now in here we have stock options. Suppose Triple Z reported a net income with a 200,000 shares of common that is outstanding for the entire year. Triple Z has got also 1,000 shares with 10% of dividend at 100 par value of preferred outstanding stock during the 2006. Triple Z has got 10,000 stock options or warrants. Do you know the difference between the stock and the warrants? So it's options and the warrants.
No.
Can you explain?
They're all almost the same. They're almost the same. They're doing the same job, but with some differences. The one difference in warrants is that you can exercise the security that you hold, the derivative that you hold it before the exercise date. Okay? But when it's same, it's not an obligation, it's an option for you. You can exercise, you cannot exercise. But in here you have a chance to not to exercise or to exercise before the day takes the place. But in the call option, the put option, you have to exercise it on the day of exercising. Okay. Example, if exercise price was 15 bucks and market price was 20 bucks, and that market price started to increase and the exercise date didn't come yet, you still having a chance to exercise it before it comes. Or you may not exercise. This is all about the warrants. So 10,000 stock options outstanding the entire year. Each option allows you for holder to purchase one share of common stock. So 1-to-1 at 15 bucks per share. Who is briefing so hardly? I think Islam. Okay. Now, each option will let you to hold one share, one stock option for one share. And the price is 15 bucks, we said. The average market price for Triple Z common stock during the 2006 is $20. So we're asked to compute diluted EPS. So what are we doing here in first step? We should arrange how many share was organized. But remember, guys, we are not touching the numerator in here because stocks and the warrants, they do not affect the numerator. As you remember, at the beginning of the class, I told you. We are dealing with the just affecting the number of the shares, nothing to do with increase in net income. So we would like to calculate number of the common shares that created if options are exercised. Number of shares created if options is exercised. Let me exercise just like this, which is 10,000 of shares, because 1-to-1 we said. Second, we said that number of shares that can be purchased at $20 before calculating how many shares can be purchased at $20, we need to calculate total value, the market capitalization. So the cash inflow, if option is exercised, cash inflow, if option is exercised, 10,000, which is 150,000 times $15 will make 150,000. And the number of the shares that can be purchased during the year, number of shares can be purchased or bought at $20 is 150,000 divided by 20, it will be 7,500 shares. And here we need to calculate a net increase in common shares, which is the difference between the number of shares can be purchased and the number of the shares created if the options is exercised, which is 10,000 minus 7,500 will give you 2,500 shares. It's a net increase in common shares outstanding from exercise of price. This is we create a common share effect. Okay. Now it is time to calculate the diluted EPS. So diluted EPS is equal to net income, which is 115,600 minus 10,000 preferred stock dividend. And this all in brackets, of course. We need to divide it by number of the share that has been added. Previously it was 200,000, but we add plus 2,500 because only in net increase in common shares, it increases by 2,500 because 10,000 shares, for each share we have one share. If the stock option is exercised or warrant option is exercised, then we are calculating number of shares that can be purchased. The difference will get the net increase. So in here we can get $0.52. So still we can calculate with the EPS in the step one. Step one, we said the EPS basic one is equal to 0.53. And this is step two.
Teacher,
Yes,
here
please.
2,500 is remained from 10,000.
Yeah, 10,000 minus 7,500. It comes, let me just put it in a bracket so that you can understand better. Minus 7,500. Okay, shares. Okay, this is earnings per share, diluted one. This is a basic one. Okay, any questions? Okay, no questions.
Professor, just a clarification that net income minus 10,000 was what? 10,000?
10,000 is the dividends to preferred stocks.
Okay, 10% of the.
Yeah. If this guy
100
is
million.
converted, look, if this guy is converted, there is another story, but this guy doesn't convert it and we just subtract it. If this guy is converted, we're going to add it back to the net income. And stock option and the warrants, they do not affect the net income. They do not affect the numerator. It only affects the denominator. Okay?
All right, thanks.
Okay, here's an example how it's calculated. Okay, now we're coming to the last example where all of the cases are existing at the same time. Like with convertible bonds, with the convertible preferred stocks and options. So triple Z reported net income, same, sorry, 115,600 plus 200,000 shares of common stock outstanding for the entire year. Triple Z had 1,000 shares, blah, 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 and we know it, into 40 shares each outstanding, and also with 600 bonds at 7% at par value of $1,000, convertible bonds, and they can be converted each bond into 100 shares outstanding entire year. And finally, Triple Z has got 10,000 stock options outstanding during the year. Each option is convertible into one share, so 1-to-1 at $15 per share. The average market price of the stock here was $20. So what is the basic and diluted EPS? Assume the tax rate is same 40%. Now we need to calculate, we need to divide into two parts. First, we will calculate what will be the change on net income, and second part, what will be the change in the common shares. And then we can easily calculate diluted EPS. So I don't need to calculate again the basic EPS, but I will start with the just what will be the effect first of all in common shares. So in common shares, we are starting with a step 2 directly. Step 2. In step 2, I will start with the preferred stocks like convertible preferred stocks or shares is equal to, if it converted, it will be equal to, we said, is 40,000 shares. Then I will proceed with convertible bonds. Which is convertible bonds.
Professor, so we assumed that in every statement, the conditions are, the options are exercised unless
Yes.
it's not stated otherwise?
Yes, yes, very true, very true. Now we're assuming it's exercise. If it's not exercise, there is no need to call it a dilution, because dilutive is calculated in case if these dilutive securities are exercised.
Okay.
And we have, of course, the exercising options. Exercising options or warrants, which is, we said, is 2,500 shares. Okay, this we calculate the change in the shares. Now, time to came is step 3. We say to see the adjustment or changes in net income. Let me make it adjustment in common shares. And the step 3, adjustment in net income. So in adjustment is when it's with the preferred stock, we said it's gonna be adding back the preferred dividends, which was $10,000. So we're adding back. And when it comes to convertible bonds, we are adding back the interest. Do you all remember how did we get it? This is just 7% of 600,000. How did we get 600,000? It's a 1,000 of par value of the bond times 600 bonds, and 7% of it minus the tax that we paid, 40. This is how we get it. And from exercising options, we get $1,000. Adjustment in net income. Any question, guys?
The last $1,000 was what from exercising option?
So do you remember what was the options criteria and the warrants? How it affects the
Yes.
numerator? What was that? So it does not affect, it doesn't
It
make
was-
any changes in net income in numerator, yes?
It was minus 10,000 and plus, right?
So we are not making anything. There is no change. It's zero. I just
Okay.
put the number just to see whether you're following me or not. Okay.
Okay. Good.
Now it's zero. This is step 3. Now we need to proceed to the step 4, which is calculating the diluted EPS. But it will be a big formula because we are adding all 3 cases into single. So 100, well, let me open the bracket directly. 115,600 minus preferred dividends plus preferred dividends back because it's converted, and plus 25,200, the interest converted and added back to income. And this all divided by the number of the shares, and if I open the bracket, which is 200,000 and basically was available outstanding, plus 40,000, plus 60,000, and plus 2,500. Oh my gosh. And which is 0, just a second. Let me calculate 115,000 minus 10,000 plus it's 0 there, 20 minus 25,000, okay. And divided by 300,000 to 300 to 500, okay. Okay, 0.47. So now I can compare with my EPS. So let me just go with the step number 1 as well, so that you can just make some comparison. My basic EPS is equal to 0.53, if I'm not mistaken. Yes. Now I can make a comparison, 0.47, 0.53. So it's my all securities are diluted. So my dilutive EPS is 0.47, which means that my EPS is going down. So guys, remember that EPS is measuring the performance of the company, performance of your equity, okay, how it performs. So as the number of the share increase, it reduces the EPS. So sometimes, as the word, it actually speaks itself, the dilution, it means like deterioration, like a reduction in EPS. So as I told you, it's like sometimes it might be the case that it will increase it, the EPS. When it increases the EPS, it is anti-dilutive security becomes then. Any questions, guys?
So when it reduces EPS, it's
Dilutive one. It's a dilutive. It's a diluted.
it's not
Yeah.
good.
No, it doesn't mean it's good. It's not good, but it just shown that it reduced your EPS. And why it's reducing, it gives you some explanation on it.
Okay.
Because the number of the shares is increasing, but sometimes if the stock price might change them in the market, it may affect it dilution in a opposite direction. So it will increase it, which will make at the end to be an anti-dilutive security. Okay, let me just save this screenshot. I'm clearing the drawings. Okay. Do you have any questions? If not, I'm giving you the homework and then I proceed with Stata to do something to show it to you.
Professor, last thing to clarify,
Yes, please.
that 10,000 plus and minus, the first 10,000 minus was due to the preferred ones, 10%, and the
Wait, I opened it.
okay, the last step, step 4,
Okay.
net income minus 10,000 and plus 10,000.
Yeah, this is
So-
preferred stock dividend added back. By calculation, you might not show it, but it's better to show the explanation why it happens. You're supposed to pay the dividends 10,000 and then you're adding back if it's converted. And plus this converted interest rate after payment of tax.
So first 10,000 minus is preferred dividend we paid,
Yeah, the first and second
the-
is, yeah.
and the second 10,000 is plus. It's not minus, right?
Yeah, it's a plus that which means that we are adding back the 10,000.
Because they were exercised.
Yes. Yes.
Okay. Thanks.
You're welcome. So this would be 200 300,000 shares, and you would pay, let's say, 8% here, 2,000 shares, 800 with 9%, 1,000 per hour, okay, and 100 shares, okay, and stock options, let's say you exercise it, let's make it $25 per share. Well, let's see, and the average market price is this. Okay, this is your assignment. You will do it and submit it before Monday, okay? Just take a picture, guys, and screenshot it. Okay, I'm gonna put it in Moodle. I'll take it. I'm gonna save it. Okay.
So this type of exercises can be even harder if we add additional condition of stock dividend
Yes.
and also the dates.
True. True. Very true. It's just simple ones I'm giving you,
Mhm.
just to understand the logic behind this,
Clear,
how it works.
clear.
Okay, guys. Oops, why did I stop it? I'm gonna proceed because I have to go with Stata to show you something. That's it all for lecturing today with this chapter. There's one small thing left with this lecture with the income statement, and it's very easy one. I'm not planning to cover it. It's like common size income statement. Most of you know it. Like when you convert the numbers into percentages, the absolute terms, everyone knows how to convert it. Okay. I'll put this everything in Moodle, the homework as well. I'm gonna upload it, but I want to run the Stata itself to show you something. By the way, Islam, did you submit it?
Professor, we also have a question. What should we do? We send you data and next.
What is the question?
What should we do next?
What you should do next? I'm gonna tell you now. Example, I'm gonna run this data. Okay, I use this data. Okay. Okay, first thing that you should do is, as usual, you regress it, let's say. I want to see NIM theta, CTI, this. Islam, I'm using your data. Is it okay?
It's totally fine. As long as you like it.
Yes. Okay. Now, it's because I have your data on my desktop. That's why I just want. Now, I regress it. No observation. That's very, very good. Why it tells me no observation? That it means there are some variables that are not in.
Did you take the last? I guess you got the wrong sheet or something. Because the variables must be much. There should be many variables than this.
Let's go. I think it's not the last one, but anyway. NPL is double because I'm afraid it might be. It's not a NPL.
No,
CTI.
this is not the correct file.
It's not the correct one?
Yeah, it should be April 8th.
You send me by WhatsApp, isn't it? Yes,
Yes.
if you send me by WhatsApp, then I'll. Okay.
Yesterday around 4 o'clock in the morning.
This one? Yes. Okay. Now I can just import again.
And inside should be the second page as well. 8.
Which one?
8,
6.
yeah.
Here.
8.
Yeah, I selected the worksheet as number April 8.
Exactly. Thanks.
Okay. So by this, great, and we can run the regression. Regress just name this, liquidity to GDP, monetary freedom, bank Z score, dummy, inflation. Yeah, now you have pretty much variables. I think this is enough. I'm just gonna show you the something. Yeah, now it works great. So I did the regression, but I need to check for multicollinarity, okay? Let's start with, everyone knows it. It checks the multicollinarity when variables are highly correlated with each other, independent variables. So in here it shows it is less than 5. That makes a good model. So the selected variables are suiting, like it's good. It's less than 5, it makes good. There is very low correlation between them. So we exclude the multicollinarity. Then there is a problem of autocorrelation and heteroscedasticity. So in order to solve it, we need to run a clustering model that will correct autocorrelation and heteroscedasticity. We're using the random or fixed effect. But which model to use, random or fixed? We're gonna use some techniques in here. Let's say we use regression in here.
Post office, local hospital diye bolamайды. Екі әртүрлі сөз.
Local hospital деген это местный госпиталь деген.
Now, we are doing the fixed effect. First of all, option is not good because we're not regressing. It should be xtrec. Okay, we did the fixed effect. Now we need to save it. As fixed effect. So we save it. First, we run the fixed effect. Why we are doing this? We need to select which effect we're going to use, a fixed or random. Now we're doing random effect. They're all regression, guys, just real regression. We just need to clarify to solve for autocorrelation and for heteroscedasticity. Now with the random effect, estimate, store, random effect. Now stat, Hausmann, fixed, and random effect. So in this, I'm given the command to choose which is the best suitable. Oops. Now, yes, we go with the Hausmann. So Hausmann test, it determines whether we should use fixed or random effect. If the probability value is less than one of the significance level, if it's significant, then we should proceed with fixed effect. Okay? It tells us you should proceed with a fixed effect. If we find it out that it's not significant, then we use the random effect. So in here, we're going to apply a fixed effect because our probability value is significant. Let me repeat again all the steps. First of all, we are doing xtrec for fixed effect. Now, okay? xtrec is another command which is like regression as well. Then at the end, we are putting the comma and putting the FE. We're running. Then writing estimate, storing the value as fixed effect, let's say. Then we are running for random effect. We're changing from FE to RE. Running, then we estimate, store, random effect, random. We stored it. Then we run the Hausmann to see which of them to select. If it is significant, we're going to select the fixed effect. If it's not significant, we select the random. So random and fixed. As you can see, it is significant. We are selecting the fixed effect. So we will run the fixed effect. Now we're running the fixed effect. Now we need to adjust for autocorrelation for heteroscedasticity. In order to do that, we are doing in this way. We're adding another command, VCE, opening bracket, cluster by ID. So we're clustering by ID, which means we're adjusting for autocorrelation and for heteroscedasticity by doing this, by adding these variables. Now, we adjusted everything. So our model seems to be validated. It seems to be. However, we need to check it. So this is significant, significant, significant. But what about F statistics here? Our model is not significant. So this model is not trusted. So once we adjusted for multicollinearity, we adjusted for autocorrelation, we adjusted for heteroscedasticity. Okay? This model is not significant. This is the thing that you should do. Random or fixed effect. Random or fixed effect, we're doing to adjust for autocorrelation for heteroscedasticity. But which one to use? The Hausmann test tells us. Sometimes the Hausmann test will tell you use random effect. So this is the information that I wanted to share with you. If you have any questions, please rewatch again the video that I'm going to upload it and get in touch with me. So how this fixed effect and random effect works? It works first of all to adjust for autocorrelation, to adjust for heteroscedasticity. This is two things we're adding as a command like VCE, clustering by ID. Any questions? Okay, if you don't have any questions, I would like to stop it. Yes.
Yeah, can we talk to you about our article after the class?
Unfortunately, Janai, now I cannot do it
Okay.
because I have to leave. It's better to make it tomorrow. We can meet tomorrow.
Well, we plan to submit it today. We are doing the conclusion and wrapping it up, the results.
Or just send me by WhatsApp. If I have a chance to respond to you, I will respond to you as soon as possible.
Okay, we should submit it today or something like this.
Just send me through WhatsApp.
Okay, yeah, thank you.
Okay, if you don't have any questions, I want to stop here. Then see you guys.
Thank you.
Thank you very much. Goodbye.
Bye.